All right. Hi, everyone. Welcome to today's webinar series brought to you by IronFX, where we'll be covering the live trading session. All right. Just want to make sure you guys can uh, hear me loud and clear and see my presentation slides as well, which should be showing IronFX webinar series live trading session. Do take note, we've also got the Q&A and the webinar chat windows open, so do drop any questions that you may have in the respective windows. All right. Hi, Aaron. Good to see you. All right. We'll just start off pretty soon. All right. Okay. I think we're good to go. All right. So before we start, as usual, do take note of the risk warning that comes with trading uh, margin, Forex, and CFDs. Right? The products on INFX are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. And also, do take note that the information in this webinar should not be considered as investment advice or an investment recommendation, but instead educational material only. All right, my name is Ketan Ramachandra, and I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, just a simple agenda for today. We'll just cover some of the key uh, labor market data out of the US that's occurred this week and what's coming up tomorrow as well. We've got the all important non-farm payrolls number coming up tomorrow. And then after that, we'll dive into the charts as well. All right. So coming up later today at I believe it is 12:30 p.m. GMT time. We got unemployment claims. Okay, so what are unemployment claims? These are claims that basically made by U.S. citizens when they are unemployed, right? That's what it means. So when you have more people filing for such claims or such benefits, it means that there is some weakness in the labor market. Hiring practices could be slowing down. More people are unemployed and are potentially looking for unemployment benefits. So what this means that the economy is probably weakening, and that usually causes the US dollar uh, to lose its value. So in a sense, if you have rising unemployment claims or unemployment claims that are coming in higher than the forecast every week, that potentially should act as a negative catalyst for the dollar index as the value of the US dollar falls. Conversely, if you have unemployment claims of trending lower over the last 5 weeks, which is what we've seen. And not only have they been trending lower, they've also come in lower than their respective weekly forecast. This usually acts as a bullish catalyst for the dollar index on for the near term. Right. So as you can see, 1, 2, 3, 4, 5. We had 5 consecutive weeks of unemployment claims trending lower and coming in lower than their respective forecast. So this has usually uh, resulted in a bullish catalyst for the dollar index. Right. So for this week's forecast, there's a estimate of 211,000, which is not that far off from last week's number of 204,000. So if today's number prints lower than the forecast here. So if we get about 200,000 or lower, this is very likely to act as a bullish catalyst for the dollar index. And that means currency pairs such as the euro and the pound will fall. Gold prices will also fall, and we'll also have currency pairs such as the dollar CAD and dollar yen rising. Right. And of course, you'll have the Aussie and the Kiwi both falling as well. Conversely, should today's number print higher than the forecast, then this means there are more people filing for unemployment benefits. So this is going to act as a bearish catalyst for the dollar index. And in this scenario, you would have the US dollar, you'll have the euro and the pound rising, the Aussie and the Kiwi rising as well, gold prices rising, and currency pairs such as the dollar CAD and dollar yen falling. So this is the basic uh, uh, understanding that you should take from unemployment claims and how we should interpret the data, right? So do take note of this economic event that's coming up later today at 12:30 p.m. GMT. right? This has always acted as a very uh, impactful data point for the dollar index over the next few hours, right? All right. Now coming up tomorrow, we've got the all important or much highly awaited non-farm payrolls coming up tomorrow as well at 12:30 p.m. GMT time. So for most parts of for the last 12 months rather, unemployment claims, non-farm payrolls have always been coming in higher than the 200,000 threshold. But for the last 3 months, we have seen uh, non-farm payrolls come in under this level, which seems to indicate that hiring is slowing down in the US. So do take note, these are the number of jobs, new jobs being created or added to the labor market every month. So you had 105,000 jobs in June, 157,000 in July, and 187,000 in August, right? So you've had a relatively slower rate of uh, job gains, and for the forecast for September also points to 171,000, which is also lower than 200,000. So we're very likely to have a fourth consecutive month of slower growth for non-farm payrolls, right? So slower growth could mean that the labor market is finally saturating. Companies are not going to are not looking to aggressively hire or expand their workforce. So that could mean that the economy is starting to show signs of cooling off, which then means the value of the US dollar should weaken and hence dollar index should fall. So do take note that any number that's going to be lower than the forecast of 171,000 is very likely to act as a very bearish catalyst for the dollar index, right? Similarly, any surprise in the NFP number coming in at maybe 180,000 or 190,000 is definitely going to act as a bullish catalyst for the dollar index as well. All right, so do take note of once again how you can interpret the NFP data and how it could actually impact the currency markets as well as gold prices. All right. Moving on. Okay, this is just a summary of what I had said earlier, right? So we've seen there was a 3 consecutive months of job gains falling below the 200,000 K threshold, possibly indicating gradual easing of the labor market. So we could have a fourth possible month of data of NFP coming in under this 200K, 200,000 threshold, right? Now, okay, ADP employment report was released yesterday, and this was the lowest number in quite a while. And not only was it a very low number, it also came in much lower than the forecast of 154,000. So there's a significant slowdown in the private sector, or rather in private sector employment for the month of September, right? So as you can see, by the chief economist, is there is a steepening decline in jobs this month, as well as with steep decline in wages. And you can see large establishments actually drove the slowdown. So large establishments are companies that have more than 500 employees on their payrolls. So if the ADP, if September's ADP report is going to be any indicator of what we can expect for NFPs, then we could be in for a weaker number for tomorrow as well. So this again would act as a very bearish catalyst for the dollar index. So do take note of what has occurred so far in the labor market. Well, important data for the labor market. All right. So with that, let's just dive into trading view, and we'll start off with the dollar index and see where are the current um, resistance and support levels for the respective pairs. All right. So before we get into that, I just want to highlight that we are now currently in the 12th consecutive week of strong gains for the dollar. As you can see here, 1, 2, 3, 4, 5, 6, 7, 8. Wait, sorry. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, right? And it does look like no matter what happens tomorrow, for NFPs, we could have a bad reading. We could see the dollar index pull back. It does seem like the dollar index is going to close in the green for the 12th consecutive week. This is by no means a simple move. This is a very strong bullish trend in the dollar index, which has naturally caused the euro and pound to fall drastically, dollar yen, dollar franc, dollar cat to rise as well, and of course Aussie and Kiwi to fall. Similarly, gold prices have been depressed as well over this period. Right, so this is just to give you an overview of how strong uh, the bullish trend has been for the dollar index over the last 12 weeks. And perhaps we could finally see some slowdown should the NFP numbers miss and give us a very poor outlook on the labor market for the US. All right. Okay. With that said, now let's zoom in onto the daily time frame. We can also see there's a pretty strong trend line as well. Right. So this is something to take note of as well on a daily time frame. So should this ascending trend line be broken, right, that it could really trigger the move to the downside for the dollar index. Right. Okay. Now, how do we identify these resistance levels for the dollar index? Right. So we'll start off with the resistance. Right. So with dollar index currently trading about 106.80, the first resistance, which has been tested, which was tested on Tuesday, was identified by the high of this week here. As you can see, back on 30th of November, price made a pretty decent significant swing high here. Where's my brush? Right, price making a pretty significant swing high here on 31st of December. And then this is a level that is yet to be tested. That was yet to be tested until Tuesday, 3rd October. Right. Similarly, we see price making a very significant swing bounce here on 12th of September 2022, finding a little bit of support on the 10th of November before price finally broke through. But once price broke under, you can see price making a pretty decent, significant swing high here on 21st of November. So we see a very strong overlap level, which is now acting as a second resistance for the dollar index. And this is at 107.75 for the second resistance and 107.13 for the first resistance. Right. Okay. So this is how we have identified the first and second resistance levels. Okay. Let's zoom in a little bit here. And if you go into the 4-hour time frame, right, we've also used, okay, no, sorry. We've not used a projection. I thought we had used a projection, but it's not a projection. All right. Okay. All right. So if you go into the 4-hour time frame, we can see that on Tuesday, price did break above the first resistance, but it never, the candle, there was no convincing close of the candle in the green above this level. So that's why we're still keeping 107.13 as the first major resistance level. But we have highlighted the high of the week at 107.38.5. So there's a there is a range, I would say there's a zone of support, a zone of resistance for the dollar index between 107.13 and 107.38. All right, to the downside, we've used a Fibonacci retracement. We started this retracement from this swing low here on 29th of September, going up to the swing high here on 3rd of October, of course. And we can see that there is a pretty decent pullback support level at 106.35, which lines up well with the 61.8% Fibonacci retracement level. So do take note that this level here is an intermediate support level, and should price fall below this level, it will trigger the next move down. And do take note, we've also see the ascending trend line here as well. So we've got a pretty strong support zone for the dollar index. But if we do get very poor labor data tomorrow in terms of the NFPs, and if these levels get broken, then for sure, very likely we're going to see dollar index test 105.68. Right. Okay. So how was the first support at 105.68 identified? We see a very strong overlap here. Right. We see price running into resistance on 20th of September till 25th of September. And once price broke above it, this pullback resistance then functions as a pullback support, and we saw price very clearly bouncing off this level last week. right? It literally just bounced off exactly at this level. So once you have a significant swing bounce like this, we have a very nice overlap level. This is a very significant overlap support level for dollar index. Now, similarly for the second support at 105.13, previously price ran into resistance in early September. So this level then functioned as a pullback resistance. And then once price broke above it, you can see that from 15 September to 18 September, price found support above this level. So this pullback resistance then started to function as an overlap support, and it continues to do that uh, in the present time as well. Right, so do take note, these are the key support and resistance levels for the dollar index on the 4-hour time frame. Right. Okay. All right. See, we can also see price now consolidating around 106.50 today and starting to go higher. I believe we can do a Fibonacci projection to see if any of the projection levels line up with the resistance that we had identified. So I'm going to use the Fibonacci trend-based extension tool. So we're going to start from this swing low here on 29th of September, going up to the swing high on 3rd of October and ending with the swing low here on 4th of October. So we're going to use all the Fibonacci projection levels. Right? Projection levels help us to predict where price could end up. So once you see price making zigzag patterns such as this and it's starting to go higher, you can use the trend-based Fibonacci extension tool and draw the projection 1, 2, 3, and then we can try and use 61, 78, and 100% to help us identify potential levels that price could reach. So in this case, we do see that the 78.6% Fibonacci projection level lines up pretty well with the second resistance as well. So if you've got a second factor, that adds to the significance of the second resistance. So in this case, we're just going to keep 78.6 and we'll get rid of the other projection levels. Right. Okay. Because this was also such a strong move up, we can also do a Fibonacci retracement from this swing low here. Right, this swing low was on 18th of July, going up to the recent swing high here on 3rd of October. Let's pull up all the fibs. Let's see if any of the Fibonacci levels line up with the overlap support that we had identified. No, the only one that's close to relatively close to where the overlap support has been identified is 23.6%. The other Fibonacci levels don't really line up. But if price does break through the first and second support, we do see this level at 38.2% being a very significant level as well. We can see price running into resistance here on 25th of August, running the resistance again on 29th, and then once price broke above it, it did find support on 11 September and 12 September as well. So we see a very strong overlap level here at 104.39, which is also backed by the 38.2% Fibonacci retracement level. So we have the 38.2% Fibonacci retracement level acting as a adding its significance to the overlap support here should 105.68 and 105.13 be broken. But that's for another day. So for this case, we'll just keep 23.6% Fibonacci retracement. We'll get rid of the rest, and we can also get rid of this overlap here at 104.39. It's just something to take note of in the future should price really pull back for the dollar index. All right, okay. Now with that, we'll go on to the euro. So naturally, if we're seeing a very strong bullish move in the dollar index for the last 12 weeks, euro would obviously be pulling back very sharply as well, right? So how have we identified the current resistance and support levels? Right. As you can see, we've used the Fibonacci retracement tool here. We started this retracement from this swing low on 31st of May, ending with a swing high on 18th of July. We are using the extension level of 127% to help us identify the first support as well, right? Extension level means basically we're looking for Nike tick move in terms of price structures. As you can see, in this case, this is an inverse Nike tick move, right? You can see once price has made this bullish leg up and has started to reverse and drop down, we normally draw the Fibonacci retracement from this swing low down here to the swing high. And as price is pulling back, not only can we use the retracement levels here to help us identify potential support levels, but once price breaks under the 100%, we can then use the 127 and 161% Fibonacci extension levels to help us identify potential support areas, right? So this is how we can use the Fibonacci extension levels to help us identify major support levels. And we do that when we can recognize price structures such as this. In this case, this is an inverse Nike tick. Right. Okay. So I'm going to just keep 127%. And of course, I'm going to get rid of this inverse Nike tick as well. Okay. So that's how we found 100. That's how we use the 127% Fibonacci extension level to act as a supporting factor for the first support. Okay. Now we'll just zoom into, all right. Before that, the first support level at 1.0478 is also significant because, as you can see, back in November, 15th of November and 28th of November 2022, price went into resistance, and then once price broke above it, it found support on 6th of December as well as on 6th of January. Right, so this then became a very strong overlap support, where price does seem to have respected this level. Not exactly, but somewhat it has respected this level. Similarly, for the second support down at 1.0349, you can see a very strong overlap level here as well. Price making a significant swing bounce here on 13th of May 2022. Another significant swing bounce here on 15th of June. And then once price broke underneath it, it found major resistance here on 10th of August as well. So you can see a very strong case for a significant overlap level here, which is then acting as the second support at 1.0349. All right, so let's zoom in now to where price is currently trading. Right, so as you can see, uh, earlier this week, price did break under the first support level, but it found support close to where the 127.2% Fibonacci extension level is. So this is rather than an absolute level, this is the support zone that we have for the euro. Right, so we have a support zone that lies between 1.0450 up to 1.0478. So this has been acted as a relatively strong support zone for the euro this week. And should price pull back towards this level, I think we can expect it to find support here once again. All right. Okay, now what about resistance levels? Right, okay, as you can see, since Wednesday, price has failed to break above 1.0525. So I would like to highlight this as an intermediate resistance level as well. Right, if we zoom in a little bit, right, if we zoom in now a little bit, you can see since 4th of October, price has failed to break above this level at 1.0532. This is a pullback resistance level, a pretty decent pullback uh, resistance level. It's not really a major resistance level, right? So that is why I would highlight this as an intermediate resistance level. So should price break above 105.32, especially if let's say if unemployment claims come in higher than expected, then this would act as a bearish catalyst for the dollar index, and that means the euro would rise. So if that were to happen, then it's very likely this intermediate resistance would be taken out, and price could find a little bit of resistance at 1.0552, where the 61.8% Fibonacci projection level lies, and also the 78.6% Fibonacci uh, projection level. Sorry, sorry, 61.8% retracement level and 78.6% projection level. Now, how do we get these levels? All right. All right. First of all, the 61.8% Fibonacci retracement level was identified by using the swing high here, by drawing the retracement from the swing high here on 29th of September and ending with a swing low here on 3rd of October. So we can see that 61.8% Fibonacci retracement level lines up pretty close to where this small pullback occurred. This pullback support level occurred here, and then once price broke underneath it, this pullback support would now act as a pullback resistance. And then we also use the Fibonacci projection. Remember, projection involves 3 points. So we started from this swing low here on 27 September, going up to the swing high 29 September, and of course ending with a swing low on 3rd October. So we've used the 78.6% Fibonacci projection level to help us identify where price could potentially come up to. And you can see that we have a very nice alignment between the 78.6% projection and 61.8% retracement level. So when you have more than one Fibonacci level lined up at the same price point or similar price point, we call this a Fibonacci confluence, right? It just simply means that you have more than one Fibonacci level at that particular price point or that particular price zone, right? So this means when you have a confluence of Fibonacci levels, it is very likely to act as a more significant level of resistance or support. So in this case, it's going to act as resistance, right? Okay. Um, Second resistance here at 1.0633 is identified by this significant swing bounce here that took place on 13th of May, right? When price was pulling back sharply, it found support here at the end of May, and the euro bounced very strongly after that. Similarly, as price pulled back in September, it once again found support here on mid-September. Price made a retracement higher, fell back, found support again over a couple of days before finally breaking lower. So what acted as a support in the past, right? This was a major pullback support in the past. And then once price breaks underneath it, this is now going to act as a major pullback resistance. So that's how we've identified second resistance at 1.0633. All right, 1, 2, 3, 1, 2, 3. Okay, so this is so do take note. These are the current resistance and overlap levels for the euro. Okay, next moving on to the pound. Right, as we expected, pound has also been in a major downtrend since mid-July, and these are the current levels, key current resistance and support levels for the pound. Right, okay. So in this case, I'll put second, let me just adjust the second support. Second support, I'll probably like to set it more here. Get rid of the zone. Right, so you can see price making a pretty decent pullback, finding support here on Tuesday, 3rd of September. This we would identify this as a pullback resistance here, and then price bounced a little bit, bounced higher after that. So that's how we identified the second support at 1.2061. First, pardon me, first support was identified by this significant swing bounce here. See, as you can see, price came crashing down. It found support at 1.2125 before bouncing higher again. So this level here has acted as a strong swing low support in the past, but then of course price broke through it twice, but now it does seem to be finding support here again. Right, so this is the first support level for the pound at 1.2124. And on Wednesday, when price bounced higher, it did find resistance again at 1.2180, and we see that there's a small pullback support level here. This was acting as a pullback support in the past, which is now acting as a pullback resistance. And it also lines up pretty well with the 61.8% Fibonacci retracement level. So this retracement level was found by pulling the Fibonacci retracement from this swing high here on 29th of September, going down to the swing low on 4th of October. So we can see that the 61.8% Fibonacci retracement level lines up pretty well with this pullback resistance here. So we've highlighted this as an intermediate resistance. And of course, the first resistance at 1.2261 is this significant swing high that took place on 29th of September, last Friday. Right, so dollar strength does seem to be picking up again, right? For most parts of yesterday and today, the dollar index was pulling back, so hence the pound also bounced pretty strongly. But now we do see dollar strength coming back into the market again. Demand for the dollar is coming up again. So we do see this first support for for the pound being tested quite strongly now. All right, so do take note, any uh, increased demand for the US dollar is going to push the pound below the first support here and potentially drive it all the way down towards the second support. Now, back to dollar yen. Right, dollar yen, we can see, let me just zoom in onto the 15-minute chart for this so I can explain this, what happened here back on 3rd October, I believe. Right, yeah, on 3rd October, we saw dollar yen drop from 150 all the way down to 147.30, right? Losing 270 pips in a matter of minutes. This was primarily due to widespread speculation that the Bank of Japan had intervened in the open currency market. So what does this mean? What do we mean by intervention operation by the Bank of Japan? Because the yen is getting devalued uh, very strongly. If you look on the monthly chart for dollar yen, right, you can see the last time dollar yen trading around 150 was back in, if we're going to count late 90s or perhaps even early 90s, right? Dollar yen back in early 90s went as high as 160, and the last time price reached there was in October of 2022. And this was exactly around the same period when the Bank of Japan had intervened in the open market again. So back then, almost a year ago, the Bank of Japan started intervention operations. So that means they were selling US treasuries, selling the US dollar to buy back the Japanese yen in the open market to drive it down. Why would they want to drive it down? Because as the yen becomes devalued, their imports become more expensive, right? So in a bid to prop up the currency, they have to sell the US dollar and buy back the Japanese yen in the open market to prop up the value of the Japanese yen. So when you prop up the value of the Japanese yen in this scenario, currencies such as the dollar yen will drop. And this is what we saw uh, in the last quarter of 2022. Now, similarly, there has been widespread speculation that the Bank of Japan did intervene on, here we go, the 3rd of October. There's no confirmation uh, by any official from the Bank of Japan or the Ministry of Finance. There's only just ongoing speculation, but this sort of moves can only be made by very large institutions or central banks, right? So do take note that we could have another period where the Bank of Japan does actively engage in the open market and intervene in the open market by buying back yen. So if that were to play out, we could see the dollar yen pull back once again, like how it did in the last quarter of 2022. So this explains this big significant drop here that took place on Tuesday. But after that, price sort of consolidated and market forces took over again. Right. So, okay, now let's go back to the analysis for dollar yen on the 4-hour time frame. Right. How did we identify the first resistance? Well, first resistance is pretty clear. Right. It is the swing high, is a recent swing high that took place on 3rd of October. Because we don't see any other major overlaps. If I were to identify the second major resistance for dollar yen, it would be this swing high here that took place on October of last year. So I would use this swing high to identify the second resistance for the dollar yen, which is at 151.47. Right, first resistance at 149.98. Okay, first support at 148.41 is identified by this overlap level here. We can see price making a swing high here back on 20th of September, and then once price broke above it, you can argue that it found support here on 29th of September, and now we are seeing it find support today as well. So 148.44 does seem to be a pretty significant overlap support level, and that is why we have labeled it as such. Right, moving on to the second support at 147.26. Is there any other level in between? No. Okay, price action isn't very clean here, right? It's pretty choppy here. We're not seeing any, well, not seeing, but it's a bit harder to identify significant overlap levels here. Yeah, I don't really see anything well here. Let me see on a daily time frame if we can find anything decent in terms of overlaps. No, okay. At least on a daily time frame, 147 and 26, you can see how it has acted as a major overlap support, right? Price running into resistance here on 29th of August, sorry, and then finding a little bit of support here on early September, and then finding support again on 21st September, and of course on 3rd of October. So that's how we've identified the second support. Can I use Fibonacci retracement? Let me see. There's the trend line. Okay, whenever we use Fibonacci retracement, it's quite important for the trend line to actually capture the market structure as closely as possible. As you can see here, price is running uh, well above the trend line, is not really capturing it. So generally, this is not really acting as a very good starting and ending point. So I would not try and use it here. If it's somewhere here, nowhere, it seems to capture the trend line pretty well, or where the trend line seems to capture the market structure really well is when we use it from this swing low here on 11 September and going up to the swing high on 3rd of October. So I would use this part of the move to draw my Fibonacci retracement. All right, so let's go into the 4-hour time frame and just fine tune things a bit. And let's just pull up all the fibs to see if they line up with any of the retracement levels. All right, we do see that 38.2% Fibonacci retracement level lines up pretty close to where the 38, where the first support has been identified. So that's great. But if you look at anywhere else, 50% seems to be nowhere. Similarly, for 61, we can argue that there's a bit of support here around the 61.8% Fibonacci retracement. So let's just keep 38 and 61 and just highlight the zones as well so that we can see where are the potential support zones for the dollar yen. Similarly, here we can see price finding support here on 18th September all the way to 21st of September. So for a period of 3 days, this does seem to be a pretty important support zone for the dollar yen, which is highlighted by the by the overlap support at 147.26 and the 61.8% Fibonacci retracement level. Right. Can we do anything else? We can. I think that should be pretty much it. Otherwise, the other. Let's see. Can we do anything here? No, doesn't really capture the. As you can see, the trend line doesn't really capture the market structure really well. So we're just going to do away with this retracement and just focus on this. All right. Okay. So these are the resistance levels that you should take note of for the dollar yen on the 4-hour time frame. All right. Okay. Moving on. We'll now cover. All right, guys. If there's any request that you may have, for if you'd like me to do any analysis on any of the other currency pairs or commodities or even indices, do drop your request in the chat box, and I'll be happy to go through the analysis with you. Otherwise, I'll just now move on to gold, and then we'll probably look at oil, and then maybe Aussie or Kiwi as well, if there's time. All right. So looking at gold, right? As we know, the dollar index and gold have a negative correlation. So that means if the value of the US dollar goes up, gold prices generally tend to fall. And if the opposite happens, if the value of the US dollar falls, gold prices tend to be lifted. Right. So that's the general premise that we have. And that's what we call negative correlation. So this negative correlation can be strong or can be weak at times. It doesn't have to be always consistently strong. And it doesn't always mean that if dollar prices are up, gold prices have to be falling. It doesn't always mean that's the case, but usually that's what happens. All right. So as you can see here, despite since mid-July, right? You can see since mid-July, the dollar index was rising very uh, strongly, but we can see that gold has been actually, although gold prices have been falling, but it's not been falling in a straight line. If you were to compare it with the dollar index, we can do a search. We can do a comparison rather, right? So as you can see, the dollar index, which is now in the orange line, has risen pretty much in a straight line, right? So over this period, you would also expect gold prices to be falling, which it did until 21st of August. But then after that, even though gold, you could see dollar index continue to trend higher, right? This should actually tell us that, or should usually would signal that gold prices should continue to fall, but actually gold prices rebounded higher. So this is when you can see that the negative correlation broke down. So I'm just going to highlight this here. This is when the negative correlation, wait, hang on. Right. So over here, you can see this is when the negative correlation actually played out, right? So negative correlation means when dollar index goes up, gold prices are falling, right? So this is very clear. They are inverse to each other. But over this period here, oops, hang on. Over this period here, you can see the negative correlation breaking down, right? Over here, uh, gold prices, dollar index generally continued to rise, but gold actually found support and continued and started to trade in line with the dollar index. So in this case, in this scenario, we started to see a positive correlation between gold prices and the value of the US dollar. But then after that, we can see the negative correlation take place again, right? As dollar index continues to go higher, right? Dollar index continues to go higher. Uh, dollar index continues to go higher. Sorry, we see gold prices continue to fall. So in this case, we can see the negative correlation come back into play again, right? So you can see the negative correlation come back into play again. Although this part is not very clean, you can see the negative correlation sort of breaking down here. But then from 20th September, you can see the negative correlation play out very cleanly once again. So just do take note that this relationship between gold and US dollar can break down over time, which is what we saw from 18 August all the way to 4th of September. Okay, with that said, let's just get rid of this dollar index here. And now we'll just get rid of the boxes, and now let's look at where the immediate support and resistance levels are for this commodity. Right, okay, if you look, zoom out a little bit. Okay, first, okay, we'll start with the first support. First support has been identified by this significant swing bounce here. We can see price making a very significant swing bounce here. And even this is a very significant swing bounce. So this is a very strong pullback level for gold prices. So this is how we've identified the second support, which is 1807. First support is where price has found support recently, right? There's no other overlap levels that we can reference, or no other major significant swing low that we can reference. So for the first support for gold, we're just simply going to use this pullback support level here that has taken place since 3rd of September. Right. With regards to the first resistance, the only other major level that we can reference is this significant swing high, right, that took place in early March. So that's how we've identified the first resistance level for gold. Similarly, the second resistance has been identified by this significant swing bounce here again, right? We see price making a very significant swing bounce here back on 20th of August. So that's how we've identified the second resistance level. We've also used a Fibonacci retracement. Oops. Hang on. We also use the Fibonacci retracement starting from this swing high here, right? On 20th of September, ending with the swing low on 3rd of October, right? So we can see that 50% does line up close enough to where the second resistance level is. 23% is in the middle of nowhere. Maybe there's 38 and 50. No, 38 is not there. So we just have 50, right? So we can see that the 50% retracement level is acting, adding a secondary factor or adding additional significance to the pullback level here at 1884. All right, so this is what we have for gold, and also as I mentioned, we can see price has failed to break above 1830 this week. So I would like to highlight this as an intermediate resistance level as well. Right, this price does seem to be uh, capped under 1830 since Tuesday this week. So there is a near-term resistance level here, which I would like to highlight it as an intermediate resistance. All right. Okay, we'll move on to oil. Yeah, and so we're coming close to the end of the session, guys. Please let me know if you have any requests for any analysis that you would like to see. Do not leave it till the end of the session, because then that would mean I have to rush through it. So don't drop any requests that you may have early so that we take our time and go through it properly. All right. Okay. So here we are on oil. Right after breaking out or have starting a very strong bullish trend run since end of June, oil prices are once again pulling back very sharply as of 27 September, right? Since the end of September, so pretty much the first, I would say 7 days, 7 trading days of October. Oh, well, not seven, today's fifth, sorry. So last 2 weeks, for the last 10 days, right? For the past 10 trading days, we've seen a very sharp pullback in crude oil prices. All right, so how are we going to identify some of the levels here? All right, we have used Fibonacci retracement starting from this swing low here, going up to the swing high here. Right, we're using 78.6% Fibonacci retracement as a reference. It lies a little, doesn't lie exactly with where we've identified the first support, but it's just there to give us a little bit of a reference as well. So we can see that price found support here back on 14th of August, then ran into resistance 21st of August, ran into resistance again on 30th of August. So this is a pretty decent overlap level here, which we have used to identify as the first support. In addition, we also have a 100% Fibonacci projection level here. This projection runs from this swing high here on 27 September down to 2nd October and ends on 3rd October. So we're using the 100% Fibonacci projection level together with the overlap level to identify the first support for oil. Okay, this overlap, this intermediate support level was identified this morning. This was identified this morning. As we can see, a pretty strong pullback support level here, right? Price running into resistance 1st December. And you can argue in early Jan as well as on 12th April, and then again on 10th August. So what used to act as a major pullback resistance level will then act as a support level once price breaks above it. So this intermediate resistance level that was identified this morning has now been cleanly broken. So let's just get rid of it. It's no longer valid. And instead, I would probably just replace this with an intermediate resistance at 83.77, right? So the intermediate resistance for WTI oil is at 83.71. First major resistance for oil is at 85.52, which is this overlap level here. All right, there does seem to be all right, hi Aaron. Okay, so we as you can see, we've used mainly the 4-hour time frame, right? I've done all the analysis mostly on the 4-hour time frame, and I've only referenced the daily and weekly to get a overarching view of how that currency pair or how that security has traded, right? So basically, we do the analysis on the 4-hour time frame because that's where we're able to easily spot significant uh, overlap support and resistance levels. Because if you do it on the lower time frame, such as the 5, 15, 30, um, price action is much more noisy. It's not that obvious to spot a significant overlap uh, levels. So when you do it on the 4-hour time frame and you zoom out and you take a view of the chart of how it's been trading, as you can see here, we are running the chart from June of this year till now, right? There's a period of about 2 to 3 months. So you can see when you have this type of overview on a 4-hour time frame, you are able to identify the overlap supports and resistance relatively easier, right? So you can see here, right, in this case, price ran into resistance here on 4th of September once it broke above. So this was acting as a pullback resistance back in early September, price breaking above it, and then it finding support here on 6th September as well as on 8th September. So then this level, which was previously identified as a pullback resistance, then started to function as an overlap support, right? Similarly here, 87.28. This level here was identified as a pullback resistance with price running into resistance from 5th September all the way till 11th September. And then when price finally broke above it, this level would then act as a pullback support level, which it did. You can argue that here on 3rd of October, 2nd of October, price did break below this pullback support then, but you can see that it did give a little bit of decent support to price for it to retrace as high as 89.11 before resuming the downtrend. So naturally, once any support level that gets broken, usually that support level would then act as a resistance level. Similarly here, this was a key overlap support. Then once price broke beneath it, this would now act as a major overlap resistance level for uh, for oil. All right, so that's how we do it. So usually it's good to start with the 4-hour time frame, zoom out a little bit, try to capture at least 2 months worth uh time frame on your or period on your chart, so that you get you it might make things easier for you to spot, make it easier for you to spot the key overlap and resistance uh time frames. Okay, would you think? Yes, okay, because for us, because once we have identified the major resistance and support levels, right, we can use them to identify potential breakout levels uh, or reversals, right? So for us here at Everest Fortune Group, we use the 4-hour time frame where we identify key support and resistance levels, which we then either use these levels to play off the reversals or use these levels to play the breakout as well. Uh, and um, and okay, not only we use it to use it to play the reversals and breakout, but similarly here, once this level here at 87.28, this was previously a pullback resistance level. Once price broke above it, this then acts as a pullback support. So should we now that you can see here the trend has totally reversed here for oil. So with oil crude prices pulling back, this would be a level where we would have identified uh, a take profit level as well for WTI oil once it started turning lower as well. Right. So this is how we can use it. All right, welcome. All right, Aaron, no worries. All right, okay. So that's oil. Yeah, okay. It does look to be like in this case, because oil is very bearish at the moment, we definitely would not use this first support to play a reversal here, because we do see that the dynamics have completely changed for WTI oil. We also see the trend change significantly. So in this such a scenario, we definitely would not be using the first support to identify a reversal play. Rather, we're trying to see if uh, like for example, today, right? You can see that price didn't break above the intermediate resistance at 83.77. We would have initiated a short position here, and then we would have used this first support to help us identify the take profit level. So in this scenario, this is how we would have used the first support to identify a take profit level, because price did not retrace higher and continue to drop lower. So we would have used 81.69 to help us identify the take profit level for the short trade on oil. All right, so this is how we try and use the overlap support and resistance levels to identify potential take profit levels, potential reversal levels, and also potential breakout levels. All right. Okay, I've come towards the end of today's analysis, today's session. I'm just going to launch a poll. Uh, really appreciate if you guys can give your feedback. Do look out for all upcoming webinars by IronFX, and we will also all the webinars that you see live here uploaded onto their YouTube page in due time as well. So do take note of that. If you have missed any webinars, any past webinars, head on over to IronFX YouTube page, and where you should be able to catch most of the past live analysis webinars as well as education webinars. All right. All right. Okay, right. Thanks everyone for tuning in. Have a great trading week. And before I end, yeah, just look out for the key economic events coming up today. I just want to highlight the key events. Okay, I'm on GMT time, right? Just to make sure that we're all in the same time zone. I'm on GMT times. We've got unemployment claims coming up today at 12:30 p.m. Do take note, a lower number here, a lower number than the forecast is likely to act as a bullish catalyst for the dollar index. Conversely, a higher number is going to act as a bearish catalyst. And we've got the big one coming up tomorrow, which is NFPs, non-farm payrolls, which is here highlighted as indicated as non-farm employment change and the unemployment rate. Do take note once again, any reading much greater than the forecast, and especially if it's greater than 200,000, is really going to act as a significant bullish catalyst for the dollar index. And conversely, if the dollar prints much low, if the NFPs come in much lower than the forecast, maybe at about 150,000, right, then this is going to significantly act as a bearish catalyst for the dollar index. All right. All right. Thanks everyone for tuning in. Have a great week, and yeah, I wish you all the best in your trading journey. All right. Thank you, everyone.